Hello and welcome to the Commercial Real Estate Talk podcast. I'm your host, George Morales. Thank you for tuning in to this weekly look at commercial real estate news and events. This is episode 136, Office Woes Part 7. The office woes continue for commercial real estate, as you can see highlighted by the first article, office lease expirations weigh on CMBS market. Big losses expected for Houston building. This is coming from CoStar. But before we dive in, a few housekeeping. Who am I? I'm George Morales, president, founder of Blue Box Real Estate. We're a commercial real estate, an independent commercial real estate firm. We specialize in tenant advisory services, in landlord advisory services, and investment sales. Let us know if you need any type of commercial real estate services in the state of Florida. We're happy to help you. If we're not the best team, we will put you in line of the best team. We're doing that right now in Miami Beach. Second, if you haven't yet subscribed, please do. Pause the tape, hit that subscribe button, especially if you're listening on YouTube to the Commercial Real Estate Talk channel. We have shorts that we're pumping out. We're trying to put those out every 2 weeks. There's about 14 or 15 of them. Learn commercial real estate in under a minute or less. For a deeper dive into commercial real estate, consider picking up a copy of my book on commercial real estate office leasing. It's available at don'tsignthelease.com/book. All right, with that behind us, let's go right into this article. And we have a growing problem with the CMBS market. Again, let me remind you, commercial deals are not like residential deals. You don't have fixed rates for 30 years and you just pay and be happy. No, these are interest-only payments. Usually about 60 to 70% of the property is financed with an LTV ratio of 7-3 or 6-4. And these are interest-only payments for the first 3, 5, 7 years of the term. What happens at the end of that term? It's amortized over 20 to 30 years, but after 3, 5, 7 years, there's a balloon payment that is due. And so the property owners have to refinance. Well, imagine you have a 5 or 7 year, you bought in 19, 20, 21, or 3 year, and now interest rates have doubled. And now you have 20, 30% less occupancy. You're in big trouble. And that's what we're heading into. So office lease expirations weigh heavy on CMBS market. Whether or not an office property meets its commercial mortgage-backed securities loan, that's what CMBS stands for, often comes down to whether tenants renew their lease. That's the takeaway after reviewing CoStar data for U.S. office properties backing billions of dollars in CMBS loans in a dozen major markets: Atlanta, Boston, Chicago, Dallas, Houston, L.A., Miami, New York, North New Jersey, San Francisco, San Jose, Seattle. I mean, these are pretty much the major metropolitan areas for office product. For CMBS financed office properties in those markets that have occupancy rate of 80% or higher, the renewal rate among tenants averages 53.4% over the past 24 months. According to CoStar data, only 8.2% of the loans on those properties are in special servicing, often a sign of late loan payments. Listen, 8.2% of loans in special servicing, that's not good. For the office properties in those markets with occupancy rates of 80% or less, 24-month renewal rate has averaged 9.8%. 9.8% renewal rate. Yikes. More than 31% of those loans are in special servicing. So let's get this, what they're saying. If your occupancy rate is 80% or higher, chances are it's that high because your tenants are renewing at a just above 50% clip, which means 3, 4, 5 years ago, pre-pandemic, you probably were at 90, 95%. You have lost half of the renewals, but you're staying at 80% or higher, and you can still pay the mortgage in these rates. But if you've been hammered, like this one case here that we're going to look at in Houston, with non-renewals, you're more likely going to be in default. Only 9.8% of your tenants are renewing, and therefore about a third of those loans are in special servicing, which means they're in trouble. All right, let's keep going. The average vacancy rate in the less occupied properties is 45%, the highest in 10 years for that property group. Now listen, that's most likely your older Class A buildings, Class B buildings, and certainly Class C buildings. Suburban, CBD, doesn't matter. If you're an older property, this round has showed us since the pandemic, folks are flying the quality. It always happens in down markets. It's happening both tenants seeking to upgrade their office, and second, because they need less space, they're willing to keep the same budget but take their less space to a better building and have a more attractive building with amenities to try to get folks back to the office. Tenants in this group have given back nearly 2.1 million square feet of office over the past year and 12.7 million square feet since the start of 2019. Tenants are increasingly prioritizing a landlord's financial health. Jacob Rowden, manager of U.S. office research for brokerage at JLL, told CoStar News in an email, if they're facing near-term expiration in the market to expand, tenants don't want to waste time pursuing a deal that may run into interference from the lender. They don't want to come out of pocket for building expenses. They don't want to deal with complications that could arise from foreclosures or other ownership transfer event. The occupancy rate of the building is going to correlate with that strongly, which makes it a lot more likely that a tenant will renew in a building with healthy occupancy. The good news for the office market is that a growing cohort of corporate tenants is recommitting to large blocks of commercial real estate, helping lay the foundation for recovery. You know why that is? Because landlords are getting desperate and they're cutting deals. That includes Boston drug developer Vertex Pharmaceuticals. We actually covered them last week and their lease where they kept their corporate headquarters. All right, so let's go to Houston. Here's an example. One City Center, 607,000 square foot and change property backed by $100 million specially serviced CMBS loan is under contract, expected to be sold in November, according to CoStar. Appraised at $162 million when the loan was originated in 2015. The property was appraised this summer for $25.9 million, a decrease of 84% of its original value. There's a beautiful building there. The loan was transferred to special servicing in March of 2021 following the departure of the largest tenant, Waste Management, which occupied 41% of the space for the building. Okay? Their lease expired in December 2020. Occupancy stands at 21% with a negative cash flow. That's a problem. All right, so Moises Benzaquin, founding managing partner of Accesso Partners, which owns the property, did not respond to requests for comment. So this is just one case study, folks. This is a good case study because it shows you the problem. This property appraised for $162 million in 2015 is now worth $25.9 million. Now, why is that? And why do you not see this in residential deals? Yeah, we saw in the Great Recession, residential prices tank 30, 40, 50%. But remember, a commercial building is primarily valued based on a cap value of the net operating income. Net operating income is your gross income less your operating expenses or any other recoverable expense. And so it's highly tied to occupancy. It's highly tied to these leases and what they're paying in rent. And when you go from, say, 80% leased to 21% leased, you're upside down. You're actually probably paying more in real estate taxes, insurance, and operating expenses than you're collecting income. And that dramatically lowers the value of the property. So remember, these buildings are just financial vehicles to collect income. You're going to value the real estate based on the income that it provides on a cap value. And this is really upside down. So based on the current value, the income that the building is generating, the property is only worth $25 million. And because Waste Management left, the keys went back to the lender. All right, let's keep going because this is from Globe Street. Same tone. CRE delinquencies accelerates as industry waits for rate relief. The overall delinquency ratio for CRE loans has reached 1.45%. Commercial real estate debt delinquency continue to rise with the office sector woes Part 7, playing a particularly strong role as constituents work through bank portfolios, says S&P Global. The overall delinquency ratio for CRE loans increased quarter over quarter 16 basis point to 1.45%. That came from the higher interest rates, making refinance more difficult to obtain. You can't refinance. Look at that Houston condition. How are you going to refinance when the lender says, wait a minute, I'm not going to loan you $160 million. The building's only worth $25 million. There's a big problem. And you owe $100 million. It's a big problem. You're not going to refinance. No one's going to touch that. All right. The firm did say that a sharp decline in medium-term interest rates as Federal Reserve cuts near stands to provide some relief. All right. So the Feds are paying attention to all this. Job markets I just saw this morning also cooled off. We've spiked up to 4.2%, if that you can believe those numbers. And so the Fed's probably going to step in here in a week or two and cut rates. It's going to help a little bit. It ain't going to bail these buildings that are completely upside down now. Absent some disastrous surprise in inflation or the labor market, the Fed has already signaled a nearly certain rate cut this month, but a sharp decline in interest rates is far less in focus. Chances are that September cut to federal rates will be 25 basis points, maybe as high as 50 basis points, but that seems unlikely. When the Fed is done cutting, the total will probably be between 100 to 200 basis points, somewhere between 3 to 4%. That would be much higher than the relative peak 2.42% in April of 19. Maturing mortgage rates have been on average 4.3%. There's your problem. Maturing rates are averaging about 4.3%. We're probably north of 7 right now. All right, well, this article continues and continues. It's a good time for you to consider subscribing to the podcast, going to LinkedIn and following our page through Blue Box Real Estate. That's where a lot of these articles are pumped, and you can see these. And if you subscribe at blueboxre.com, you'll get a beautiful email every Monday, 9 a.m., and receive a summary of all these commercial real estate articles. All right, let's go. JLL estimates $1.5 trillion in maturing debt by the end of 2025. Folks, we're in September 24, so we're talking about 15 months. Essentially, $1.5 trillion of maturing debt, roughly 25% refinancing challenges. 40% of those property needing refinancing are multifamily units, meaning that a focus on office as a risk area may not address enough. Okay, that means there's other sectors that are on the chopping blocks, okay? Then that's the end of that article. Okay, let's go on. Now, again, why is this all happening? Partly because of this. This is from BizNow. The fifth Labor Day since the pandemic began. Return to office rallying cry falls silent. Now, usually Labor Day is the time where we mark, okay, everybody's back to work, back in the office, back in business, and we get probably 50% of our deals done between Labor Day and the end of year in commercial real estate, especially for office. But this was not the case. This will not be the Labor Day that finally draws everyone back to the office, and realistically, that day might never come. And it's a little bit of a hyperbole. I think it will come, but not right now. Fifth Labor Day since the pandemic began passes. Return to office proponents appear to have moved through the stages of grief, finally accepting that the end of another summer won't convince stragglers to suit up and come in. The holiday once brought bold pronouncements, creating cajoling and even threats. This year, office cheerleaders are mostly silent. Settled numbers indicate hybrid environment is working out for most, and while certain industries might continue to push mandates, office utilization will never be what it was pre-pandemic. That's a huge statement. The industry has accepted the new normal, says Marisha Clinton, VP Research at Savills. Office buildings, according to the U.S., across the U.S., were about 63.7% as busy in July of 2024 as they were in July of 2019. Avison Young's Office Busyness Index, a new measure of office occupancy that utilizes anonymized mobility data across 4,000 U.S. buildings. That's up from 52.9% in July of 23, but many researchers and employers say that they aren't expecting another major boost this year or even next. In other words, this could be as good as it gets for the foreseeable future. Again, that's why this all relates, okay? These delinquencies are up, and you've got all these CMBS loans that are due. Well, what's happening? Tenants are downsizing. If they're renewing in place, they're downsizing. They've been paying and covering costs. I'm sure the article hopefully will go into lease expirations because that's really where the rubber meets the road. There are tenants who signed 10-year deals in 2015, 2014, 2016 who haven't been able to implement this pandemic hybrid work in place business strategy, and now those leases are starting to come due. 7-year deals signed in 2018 and 19 didn't foresee a pandemic. Now those are coming due. The 5-year leases are coming due. But this is where we're heading. Hybrid work is here to stay. Let's go. Here's what CBRE says. Most organizations have accepted hybrid working patterns as the new normal. CBRE found in its annual office occupier sentiment survey released in August. 64% of occupiers surveyed said their office utilization patterns are steady. That's up from 60% in 23 and 43% in 22. All right, let's keep going. Let's keep going. There is now no significant movement to get employees fully back into the office, according to the study conducted on behalf of one of the companies that benefited most of the hybrid work movement. Zoom. Hybrid work is king, according to the online meetings giant. So Zoom, I guess, is back in picture. They start up, they brought down, they're back up. About 64% of respondents in August 23rd Zoom survey said their workplace is implementing a hybrid model. All right, let's keep going. Let's see here. Office Busyness Index hit a low of 10.7% April of 2020. We're all on lockdowns now. It's 63% according to Avison Young. What I am looking for is lease expirations. Here, there's a beautiful picture of an empty space. Return to office trends vary widely depending on industry. Engineering, architecture, construction, building materials industry saw the highest busyness factor. I guess they're 81.9% using their office. The tech industry suffered more than 400,000 layoffs since 22, is at the near the bottom, 54%. San Francisco, the largest concentration of tech companies, are 53.8%, so just over half use of office. Outer boroughs of New York City reach 87.2%, highest in the nation. Congratulations there. Highest in the nation, New York City. All right, so this didn't go into it. Let's see if, whoops, no, we're not looking for new watches here. Job market reports. This will be the last article. What really this article needed to also overlay to really complete this article is let's look at the lease expirations. And usually, listen, 5-year leases, for the most part, whoops, I sent a signal to my camera. I didn't mean to do that. Let me do that again. Okay. 5-year leases, usually, that means 20% of leases roll every year, right? 1 out of 5. But you've got 7-year, 10-year leases. So let's say 15% thereabouts. Maybe you have 3-year leases, maybe 15 to 20%. So you still have a huge swath, maybe 40, 50% of the office industry set to expire in the next few years. And they haven't been able to enact this work from home policy. So this is going to continue to cause less demand, continue to see lower square footages on renewals and non-renewals. And this is going to be a continued problem going forward. And listen, this has a potential of dragging down the whole economy. Let's go to job markets. Okay, layoffs climb. This is from the Business Journal. Layoffs climb at certain types of business as job market cools. Okay, the cooling labor market is hitting the small business the hardest, with layoffs of these companies now on the rise. New data from the Bureau of Labor Statistics, which, if you were with us 2 weeks ago or 3 weeks ago, we talked about how they were off like 880,000, almost 1 million jobs this last year. So take what the Bureau of Labor Statistics reports with a grain of salt, okay? You're going to have to wait a few months, if not a year, and look back and see if they were actually accurate. I've lost faith, or certainly they've lost credibility in their reporting. But what they found that 1.1% of the layoff rate in July was up slightly from 1%. There was a big disparity in layoff activities depending on business size. Small businesses are now the ones more likely to be cutting workers, while bigger businesses are holding on to them or even adding employees. The layoff rate among small businesses with 1 to 9 employees more than doubled from 0.9 to 2% at the end of July. This is also up substantially from the same time last year when businesses of that size saw 1.5%. Small businesses with 10 to 49 employees saw layoffs grow from 0.9 to 1.2, but the layoffs rate among businesses with 50 to 249 dropped from 1.2 to 0.9, and businesses of 250 to almost 1,000 employees held steady at 1.3. Also, between June and July, businesses with, we've got everybody covered here, 1,000 to almost 5,000 saw a layoff decline, and businesses with 5,000 also dropped. So it's the small businesses that are vulnerable. This is what whoever this is, Elizabeth Renter from NerdWallet, said small businesses are most vulnerable to economic turbulence, whether in the form of higher input costs or higher interest rates. She also added that small businesses try to hold on to workers longer than larger ones in stressful times. They also have less financial installation, which makes painful position for small business owners and workers alike. Listen, small business owners are getting hammered. They're getting hammered 2 ways. You've got all these cities, say in California, of all places, promoting, higher labor wages, hourly rates. and couple that with inflation. So if you're a restaurant and you're now paying double for your bread, double for the eggs, double for the meat, double for the milk, and now you're also paying $15, $20 an hour, they can't continue to raise their food prices to such a degree to keep up with that because people start coming in. So what happens? They have to lay off people, and then they go to other people and say, can you work longer? Can you pick up their shifts? It's a burden on small businesses. They can't hide that. When you have 1,000 employees, you can hide higher increases, spread it around. Walmart gives a 25-cent increase to their T-shirts, and nobody really raises an eyebrow. They could absorb these costs, but a small business can't, and they're getting hammered all over. And then they have an equity business line of credit where they have a revolving credit that used to be low, and now it's double digits. And again, it's got to come from somewhere, and it's coming from losses. And what's probably happening is the chief or the business owner is probably having to work more. And I know you say boo-hoo, but that's what's happening. They're probably laying people off and sliding back in and handling more of the business aspects than they would have handled because a lot of small business owners, they're entrepreneurs. They probably own one or two. They probably own, say, a little Subway franchise, and maybe they own a little print shop, and maybe they own a little coffee shop, and they have people, managers in place. But when things get crunched, they're going to have to step back into some of those managerial roles, cut salaries in order to get by. And so, again, inflation, high labor cost, everything, high interest rates is really right now compressing on small business owners. And look, then you overlay that with regulations from cities and permits and fees, and it's a recipe for disaster. And that's why it's the small business owners that are in trouble. Now, economists agree that while job market is slowing, it doesn't yet show signs of recession or long-time weaknesses. The Federal Reserve is also widely expected to begin lowering interest rates soon. Overall, there's no cause for alarm in today's data, but the labor market is undoubtedly cooling. The decrease in job openings indicates employers' demand for workers has eased while hiring has slowed, and it's not dropped significantly, which is a good sign. Now, remember, overlay that with 1 million jobs essentially disappearing last month from the Bureau of Labor Statistics, and I think they're giving it a really, really positive spin. I think Wall Street, State Street, Work Street, whatever you want to call it, and the feds and this labor are not syncing. There's a disconnect there. And so whatever you can, research released by Challenger early this month showed American companies had announced 460,530 job cuts this year through July. That was down 4.4% from 2023. It's the third highest since 2009, since the Great Recession. And again, and that comes along with the 880,000 or whatever that number was. Don't quote me. That the labor statistics got incorrect. All right, so I hope you see how all these tie together. Job market cooling. Folks are not returning to the office. Commercial real estate delinquency are increasing, and we have this office lease expirations weighing heavy on the CMBS market. This is why I've entitled this Office Sector Woes. Listen, commercial real estate's all about demand. As my old boss, Alan Morris, used to say, Mr. V doesn't pay rent. Mr. V meaning vacancy, doesn't pay rent. Space is vacant if we don't have expansions, if we don't have job growth, if we don't have industry growth. Instead, what we have is everything's kind of status quo, if not going backwards, because folks are working from home, and therefore they don't need these office spaces. So every opportunity they get to renew the lease or cut space back, that's what we're seeing, and that's putting office landlords spinning, trying to figure out what am I do with this debt, and that's got the Fed spinning. What are we going to do to help these major office owners? I mean, listen, major office owners, Nuveen, Blackstone, BlackRock, these are major players, and they're all being paid attention to, because if they start giving money back or the buildings back to the lenders, it's going to bring the whole system down. So we got to watch this, and we're going to have to watch this for the next 2 or 3 years. This isn't okay, hey, Fed cut, new election, here we go. No, this is going to be a problem. It's going to weigh heavily on the U.S. economy until we run through this round of lease expirations. So it all starts here in demand and lease expirations. We got to track this. Now, certain markets like Miami, are hedged in a little bit, maybe Austin or Dallas, because of all the influx of business. But certain pockets, even within Miami, Coral Gables, Airport West, Miami Lakes, certainly Miami Gardens, which I don't think they ever even recovered. Got to pay attention to these markets. All of this to say, this would be an excellent time if you are an office investor. And I said this last week. If you have a lot of cash raised and you're sitting on the sidelines, now's the time to look. You're going to get an audience with some of these landlords who are in trouble with their debt. And remember, 100% of the value of the building, debt's maybe 50 to 60% of that. So if you can find one of these landlords that they're in trouble, they're already finally faced the music. They're lost their equity. But rather than tarnish their name and lose even more by handing the keys to the bank, maybe you can come in here and just take over the debt. And you come in with your own financing and you can pick up these properties at 50, 60% of the value. Okay, 50, 60%. That's a great place. That's a different basis point. Now you have the ability to go sign new deals, renovate the buildings, and work deals. The current landlord can't because he's in it for the whole 100%. All right, if that makes sense for you, blueboxre.com. And we're talking to landlords all the time about, hey, let us poach around. Let's see what your office is worth. And we'll show it to a few key investors. And maybe this could be a win-win for everybody. All right, listen, thanks for tuning in. Remember, Proverbs 20:18, plans are established by counsel. By wise counsel, wage war. If you like this podcast, want to see more information like this on commercial real estate, give us a thumbs up. Share us with others, subscribe, and God bless you until we talk again. Good day.